Hey, what's up, guys? Hope everyone is doing well this evening. So today it is just going to be me on the live stream. Just going to be talking about some is just going to be recent things that's been going on in the stock market, I guess. I'm going to talk about taxes a little bit, probably, and just answer any questions any of you guys might have or any discussion points you want to bring up. So I guess the first thing is just to talk about the overall market. And so if we just look at the SPY here, the last few weeks have been a bit choppy for sure, but from the peak it was about 480, and now we're down to about 446. So that's should be close to a 10% drop, maybe about 8%. I guess if we look here on Google, we can get a better idea of where we're at really. Year to date, down 7.2%. And if we go back to find that actual peak, yeah, it's still about 7.2%. So yeah, year to date, down about 7.2%, which really, in my opinion, is really not that bad at all, considering what could have happened, at least from my estimation, based on some of the news surrounding, issues in like Ukraine. Usually that kind of stuff has fairly negative impacts on the stock market. Usually it's not super long lived, but I'm honestly surprised that kind of news didn't have any more drastic effects. I guess I haven't really been following it super closely, but if it, escalates some more, I'm sure there would be some downward pressure more so on the market. And then if we look at the Qs, I think they are down just a little bit more year to date, down 12.5%. So actually almost double the amount of SPY, which I think is pretty interesting. And it sort of echoes to me sort of how the big technology companies that kind of control the market, overall, they're doing okay. And so SPY is not as affected, even though a lot of other companies are, falling pretty drastically. And a lot of, decently sized companies, you could say, have been falling pretty drastically per se over the past, few years, or sorry, few months or so, since maybe October or November. A lot of that stuff has been falling. Like, if we just take a look at something like maybe Clorox, for example, that's been falling over the past few months, and definitely this year, obviously it had that spike down because of earnings, I think, but if we look back a little bit more, it's kind of been falling generally the whole year. So some companies like that overall, I think Walmart is in kind of a similar situation. Companies like that, they're still pretty big companies, but overall they've just had not a stellar year or past few months. And year to date on Walmart, they're down 7%, which isn't bad. But we can see, in November they were significantly higher. So I guess my point of what I'm trying to say is that a lot of companies overall have fallen, maybe a bit more than the market, but the market's kind of being propped up by those big companies. And I sort of think that is part of the reason the market seems like it's, staying up a fair bit, even though a lot of those companies are, falling down some. And yeah, like Dan pointed out, interest rate hike news has definitely been affecting the markets and sort of making people less certain, I guess, of equities and current, status of the economy, I guess. And another one that I've been looking at is Store Capital. They've definitely been down pretty drastically the past month. Well, I guess not that drastically the past month, but maybe if we, yeah, year to date, they're down around 11%. And if we look at the dividend yield, it's probably a pretty good time to get into store, from my estimation at least. I think I'm actually going to make a video for this weekend talking about store, and I guess just a little bit of a stock analysis type video on store, because it's one that I do own in my Roth IRA, the REIT, and it's one that is pretty high quality in my opinion at least, and they sort of, the way they differentiate themselves from other REITs, I guess, is that they look into their tenants' financials and stuff like that before they even let their tenants rent from them. And they mostly do, I believe they mostly do triple net leases, so they don't have to worry about, insurance or maintenance and stuff like that. So if we look at the dividend yield on store, obviously it went way up. Looks like they were close to above a 9% dividend yield, in the pandemic crash of 2020, which I would have loved to pick up the stock there. But you can see, over really the past year, the dividend yield has been fairly low, and now it's creeping back up almost to about 5%, which is pretty good, I think, for this type of company. And if we go back here to the overall view, they have been growing their dividend, not super rapidly, but for a REIT, I think it's pretty good at about 6% per year. I don't know if this dividend growth is accurate. I think they might have been growing it for longer than 6 years, but we can look at the history here and check it out, because that's definitely something. So they increased in 2021, they increased in 2020, 2019, 2018, 2017, 2016, and 2015. So, and 2014 technically. So I guess they have, I guess about 6 years of dividend growth. I thought they'd been around longer. But if we look at the max, they basically went public in 2014, at the end of 2014. I thought they went public a lot earlier, to be honest. I thought they went public maybe like 2008 or 2010. Really wish I could have jumped in here, $16 per share. That would have been pretty awesome. But, it is what it is. Obviously, if we knew what would have happened after the March 2020 crash, we would have been buying a lot more crazily than most people were. And I was honestly buying a fair bit. I definitely bought a fair bit too early in the crash, end of February, beginning of March, before we really got to the bottom. But, overall, at the end of the day, those were still fairly good buys, and, still have some good gains from that. Good to see Bill in the chat. And yeah, I do. I definitely like store at this price, and have been buying it a little bit here and there the past few weeks. I think it's a this price is, I think my cost base is probably around $32 or $33. So this is definitely below my cost basis. The current price around $30, but at this point, I'm just buying a little bit, not trying to go too crazy. And I think I have maybe 30 or 40 shares. So, buying a few shares at a time, that doesn't really decrease the cost basis all that much, but over time, that will add up to something. And I will, just continue adding to store. And Realty Income is the other REIT I own. And honestly, I haven't really bought any in a while. The only, Realty Income I've bought anytime recently, I think, was my Realty Income that I pretty much buy every month from Drips. So I also own Realty Income in my Roth IRA. And so in that account, I just have the drip turned on. So every month they pay me like, $6 maybe in dividends. And I just reinvest that back into the company, which is pretty awesome. Hey, Jack, good to see you in the chat. But overall, it's just not at a price that I'm really attracted to the stock all that much right now. If we look, let's see here, O stock, and we kind of check out the price a little bit. Right now it's at $67.44, and you can see over the past year, it's generally up. And I think I, probably stopped buying when it crossed above that $60 level. Which I think $60, even like $65 isn't that bad, but I just wanted to get a little bit of a better deal, and definitely wish I bought more. Obviously down here, it did jump up to around the $60 level fairly quickly after the March 2020 crash. So I can't, beat myself up over it too much. But definitely hope to get some price action down below, maybe $65, $60. Obviously, it's still at a fairly good discount to where it was pre-pandemic. It hasn't really been at these prices since, April 2019 and before January of 2019 and before. But, over that time period from, mid 2018 to the mid 2020 or March 2020, it really grew pretty rapidly there. And so right now it's just kind of making its way back up. And we can also look at some of the dividend metrics on this one as well. They have a lot longer dividend history than Store Capital, but the attractive thing about Store Capital is they are a much smaller company, so they are obviously, first of all, they're generally going to be growing faster, so they can increase that dividend more. So right now, Realty Income is $27.3 billion, and Store Capital is probably around $8 billion, maybe $7 billion, $8.37 billion, yeah. So Store is about a third the size of Realty Income, so definitely have more room to grow. This here says our 5-year dividend growth rate is 3.37%. I thought it was closer to 4 or 5%, but 3.37%, not terrible. And the dividend yield on this one is 4.41%. So right now, that's lower than Store Capital's. That's actually really interesting to see. If we look at the yield over time, which is something that's kind of interesting to look at least. If this ever loads, we'll probably see a pretty interesting trend that it's been, pretty low in comparison since, the crash. So I guess at this point, it's been, under 5% since June of 2020. So that's pretty interesting. And right now it's around 4%, a little bit above 4%. So I definitely would have expected it. I definitely thought Realty Income's dividend yield was a little bit higher. Definitely would have liked to get in closer to the 5% level. But if we look at the annual dividend and sort of do the math there, the annual dividend is $2.96. So if we want them to pay a dividend yield of 5%, that means we multiply the annual payout by 20. So 2.96 times 20. That means they have to be under $60 per share currently to be paying a 5% dividend yield, which, like I said, it's pretty interesting that I said that I want to be buying under $60. So that's kind of interesting. But 5% dividend yield equates to around $60 per share. Where if we are just looking for a 4% dividend yield, we multiply by 25, so that's up $73 per share. So that's very interesting that their dividend yield is that low. I definitely thought it was a bit higher, like above 5%. And with that 4% dividend yield and the less than 4% 5-year dividend growth rate, it's really not as attractive. So I definitely don't think I'd want to be buying, above $65 and probably try to stay away from it until we get closer to, 60 per se. Hey, Rich, how's it going? Good to see you. Glad you enjoy the videos. Rich asked the question, are you a QYLD fan? And I guess I'll give my take on QYLD because that's sort of what he asked. In general, I would say I'm not a fan of QYLD. Um, but that comes with a caveat, which is I'm not a fan of QYLD for me with my investing strategy, my investing goals, which my goals, part of my goals are my time horizon and how quickly I need to grow my investments. And I guess the point I'm trying to get at is with QYLD, it's not something that is really going to grow your investments. It's more about preserving your capital and giving you income. At least that's the way I see it. So, for me, at this point, I'm pretty young and I'm not gonna, need these investments, anytime soon, really. So I'm at the point where I'm trying to aggressively grow my investments pretty much as fast as possible, um, while also obviously having some risk protection and risk management, of course. But I really don't want to be, going a capital preservation method, which, I see QLD as more of a capital preservation method. And to be honest, not that great of a capital preservation method because, it's down about 9% on the year, or sorry, it's down about 6% year to date, which actually is not that bad considering that the NASDAQ is down about 12% year to date. So honestly, that's really not that bad to be down 6% year to date. And if you consider the past year, it says they're down about 9% the past year, but their dividend yield is around 11 or 12%. So at that point, you're definitely preserving your capital and getting a little bit of income off of it. And but the thing that I see is, if we compare the chart of the NASDAQ to QILD, QILD is supposed to be like based off the NASDAQ essentially, right? Covered call ETF on the NASDAQ. So when you look at the NASDAQ, the NASDAQ has grown a lot over the past year. And even though it's had this drawdown recently, with this drawdown, right, the NASDAQ is not up that much on the 1 year time frame. So on the 1 year time frame, the NASDAQ is only up 7%, which is very good. Honestly, that's not a bad year. But on the 1 year time frame, like I said, the NASDAQ is up 7%. And we can see this growth on the chart throughout the year. And then it fell off a little bit, right? But with QLD, throughout the year, there really was not much growth at all. If anything, it traded sideways or downwards a little bit. But we still saw this drop off. So I guess my point is that the actual fund didn't really grow that much throughout the course of the year, the price, but so it didn't grow with the underlying index. But what happened is that it fell with the underlying index, which is not good if you're not going to be able to grow with the index as well. So I guess that's my point. And so overall, like I said, I think it's not bad if you're trying to get some income off a portfolio and looking to use that income, and you're not necessarily going to be reinvesting. But I guess if you're someone that's younger and you're just trying to reinvest to grow your portfolio over the next 5, 10, 15 years or more, I don't think QILD is that great of a choice. And even if you have like fairly low risk tolerance and you don't want to be managing individual stocks and stuff like that, I still think you have better choices in terms of other index funds like maybe VOO, for example, or VTI, which sort of track the overall market. So I guess, like I said, I would just say I'm not a fan for myself because I'm focused more on growing my investments pretty quickly, and I just don't see QLD as something that's going to do that for me. But I guess it definitely can have its uses for some people who are looking to use income, I guess. So hopefully that helps. And I guess the next thing I wanted to talk about kind of went over a few stocks I guess I was looking at. I guess we can look at NextEra Energy. Let's bring that up because the stock has been down a fair bit in the past month. They dropped here, so they're down about 8% in the past month, and they've recovered a bit, but they're down. Wow, I did not realize they were up above $91. They're down about 18% year to date already, and down 7% over the past year. Obviously, they've done pretty awesome the past 5 years, but I guess what my point is, I think it's a fairly decent buying opportunity. I believe I definitely bought some down here when they dropped pretty quickly there. Down, I think they were down below $70 for a minute. Let me check my account here and look at what I bought. I'm not gonna, screen share my account for sure, but I can check it here and let you guys know, I guess. But I believe I bought some of NextEra Energy stock when it was around the $70 range, which I'm pretty happy with, and I probably would have bought more, but it's just not something I want to be a huge part of the portfolio. I actually don't own this in my account. This is in my brother's account that I sort of manage for him. But like I said, it's not something I want to be a huge part of the portfolio. But if I look at my position right now, it's about 6.8% of his portfolio. And it looks like I did buy some shares on the 28th and 27th of January for around $70 per share and around $74 per share. So that's pretty awesome. And then the last time I bought shares before then was March of 2021. So really happy we sort of got that little buying opportunity there. And definitely if the stock goes down closer back to 70, I think I'll be buying more. But I don't think I would want to, if it gets back up to like 80, that's definitely out of the question. The current price I would say is not too bad, but for my position size, I guess, that I want for this company, it's, at a decent position size for me at the moment. So it would require, a bit of an additional discount in my estimation to make it worth buying and sort of making it overweight from the point of view of where I want it for my portfolio, if that makes sense. So we can look at the chart, more of a chart form here. But yeah, we do have some nice resistance here around the $72 level. And I did get in there intraday around the $70 level, which was super awesome. Very exciting to, get right near the low. And we are kind of, reaching that 20-day moving average again. And so we could see some interesting stuff happen. We could reject that or we could break above it. Both are options. And it's definitely, I think you could definitely say it's sort of consolidating right here. So it could definitely move either way at some point in the future. So definitely something to look at. But for me, unless it goes like way below 70 or something, I probably won't be buying. Just like I said, because of the position sizing and what I want my position size to be. And Jack actually asked about taxes, which I was going to talk about a little bit later, but we can talk about it now. So he asked, what's the best way to lower your taxes from stocks? Which stocks or ETFs to buy and not to buy? So there's a few different answers for that, I guess. First answer would be just to not sell your stocks, because there's two basic ways you get taxed on investments. And the first way is through capital gains, and then the second way is through dividends. So the first being capital gains, if you sell your stock, then you're going to pay tax on basically any profit from that sale. So that's calculated as the amount you receive from selling it minus your cost basis. That's your profit. So then you're going to pay taxes on that. But your tax rate can be different depending on when you buy or sell that. So if you buy a stock and then sell it within less than a year of buying it, then that's called a short-term capital gain. And generally speaking, you pay a higher tax rate, which is generally your regular ordinary income tax rate on that. And then if you wait longer than a year after buying the stock to sell it, so if you sell the stock more than a year after buying it, then you pay what's called the long-term capital gains rate, which is generally lower than your ordinary income tax rate. So that's advantageous to hold stocks for more than a year after you buy them. And there's some interesting things there. The one thing with Fidelity I like, and I think you can do this with Vanguard maybe, but for example, something like Robinhood, you can't do this, which is selling lots. So it basically, if you buy a stock more than once, so say I bought a stock the first time at $50, the second time at $75, the third time at $100, and then you can when you go to sell your stock, if you don't sell the whole thing, you can choose, if you don't want to sell the whole position, you can choose to sell individual portions based on when you bought. So if I bought, like I said, one share at $50, then one at 75 and one at 100, when I go to sell, I can choose whether I want to sell the one share that I bought at 50, the one at 75, or the one at 100, and that will affect my capital gains because the profit will be affected by that, but also the time frame could be affected, which could affect whether it's a short-term or long-term capital gain. So that's capital gains. So I guess the best way to lower taxes from capital gains is to wait more than a year, or not sell. Or I guess the other way is sort of tax loss harvesting, which I'm not the biggest fan of, but basically what that means is if you have some capital gains and you also have some stocks that you're losing money on, you can sell those stocks for a loss, and those losses will offset those capital gains. So if you make $200 of profit on stocks from selling them, and then you lose $100 from selling some other stocks, well, then you're only going to pay taxes on your $100 of net gains, if that makes sense. And then the other way that you can be taxed, the other basic way you can be taxed on stocks or ETFs is through dividends. And so, again, sort of like capital gains, there's two different forms of taxes on dividends. So there's qualified and ordinary dividends, or qualified and non-qualified dividends, however you want to say it. And generally speaking, when you're investing in dividend paying companies or ETFs and mutual funds, the most of the stocks or ETFs are going to pay qualified dividends in most cases, which I can elaborate on that a little bit more. And then the stocks that are not going to pay qualified dividends, that are going to be taxed at your ordinary income tax rate, will be Reits, which are real estate investment trusts. And I'm not exactly sure how it works, like if you invest in a real estate ETF, for example, or something like that. I'm not sure how exactly that works, if that's considered an ordinary or qualified dividend. So that's definitely something you'd have to look into more. And then I guess to elaborate on the qualified dividends, I can look up the rules here pretty quickly, but I think it's basically you have to own the underlying asset for 60 days of the surrounding 120 days of when you receive the dividend. So basically, if you buy the stock like the day before of the if you buy the stock the day before the ex-dividend date, and then you pass the ex-dividend date, so you're eligible for the dividend, and then you sell the stock the day later, well, then that dividend is not going to be qualified. So you have to meet the holding period. And we can sort of look here. Let's see. So I'm pretty sure it's 60 days, but I'll check here. Try to find it. Yeah, so I'll share the screen for the holding period. So you have to hold the shares for a minimum period of time to benefit from the lower tax rate on qualified dividends. Common stock investors must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date, or the date after the dividend has paid out, and after which any new buyers would then be eligible to receive future dividends. So basically what that means is if you buy the stock, 60 days before the ex-dividend date. You can sell it the day after the ex-dividend date, and that dividend is still qualified. And you can also buy the stock the day before the ex-dividend date and then sell it 60 days after the ex-dividend date, and that dividend is still qualified. So that's basically how that works. And essentially, if you're just kind of a buy and hold investor when it comes to dividend paying companies or ETFs, you don't really have to worry about this because, if you already own the stock, more than 60 days before the ex-dividend date, then, you own it that 60 days. And if you buy the stock, less than 60 days before the ex-dividend date, then if your strategy is just to buy and hold, then you're going to own it that whole 60 days after the ex-dividend date. So you really don't have to worry about it from that perspective either. So I hope that makes sense. It's really not that complicated, but the, I guess, wording sometimes can get a little bit tricky. And I think overall, the best way, I guess in my estimation, to lower your taxes from stocks is just to not sell, because especially when you get increasingly invested, where you have thousands or tens of thousands of dollars in the stock market, if you're buying and selling like fairly frequently, you could be racking up a fair bit of gains, and then you're just going to have to sell or pay those taxes. So that's definitely something to consider. On the other hand, if you don't sell, then you can always lose those gains, and nothing there is guaranteed, right? So there's definitely a balance there. But honestly, for me, taxes with investing is really not something I try to worry about too much. Like, I try not to make too many investment decisions based on taxes, I guess. And maybe that's just because I don't make that much money right now, so I get most of my, if not all of my federal income tax that I pay, I get most of that back in the form of refund right now, just because of my fairly low income. So maybe that will change in the future when I start making more money. But for me, I guess I try not to worry about taxes too much with investing. And my sort of mindset is that if you're not paying taxes, you're not making money. Which maybe I just don't like fully understand it and fully understand how people do things with taxes. But from my perspective, that's just what makes sense, because people talk about tax loss harvesting and selling positions for a loss to offset their capital gains. And in theory, that makes sense because you're lowering your capital gains, but then you're just not making as much money from your investing activities. So is it really worth it, And for most people at most tax rates, like if you make $100 more, you're gonna pay like less money in taxes than that $100. So it's still worth it to make that $100, even if like you paid 50% of it in taxes and you only keep $50. Hey, Market Scraper, good to see you. Let me know if you have any questions or insights about the stock market recently. Just trying to talk to you guys today and talk about some of the stocks I've been, I guess, looking at and thinking about buying, just some core dividend stocks. I guess we could talk about my options a little bit, because that's something that's interesting and exciting, I guess. So I have an option on Square. Let's look here on the Finvis. I have an option with Square, which has really been destroyed recently. So I'm not sure what I'm going to do there. But right now I have a 130, 125 put credit spread. So basically my max loss there is $500. And if the stock is for March 18th. So if the stock closes below 125 on March 18th, then I basically achieve my max loss, which is it's really like $370 so dollars because of the credit I received. But I think obviously Square is a fair bit below that price, or around 109 right now it looks like. So we still have a month, so we can get some theta decay going there. But at the same time, we would have to see a fair bit of upside, like 10% or more, in order for that position to probably become profitable. So I really don't see us making a lot of money at this point. It's about not losing a whole lot. And I'm thinking, just going to have to try to let theta do its thing, and hopefully the stock will recover some. And, maybe I will try to roll it again. I'm not sure on that, but I know for now, I'm just going to wait another week or two and see what happens. And right now, it has fairly good support around this level. So I don't really expect it to drop like all that much, but I guess it could happen if it drops more. And, if I do end up taking that max loss, I guess, that's that. And I learned my lesson because this was definitely not the best trade, but I probably also got a little bit unlucky, but I could have managed risk better by choosing not to trade on something with the volatility of a company like Square. And so yeah, I guess that's where I'm at with that position. I really don't have much to say about it, but basically I'll probably try to get out of this position sometime at the beginning of March, just because I don't want to get assigned early on this position because that would not be good for my account. And I really don't have the liquidity to cover that if I get assigned early, so I don't want that to happen. And so basically I'll try to exit around the beginning of March, I would say. And I also have another trade. That's pretty much my only credit spread right now. But I have a put on Palantir, and I think right now Palantir is around $14 per share, so it's really not that bad. My put is around the $15 level. Yeah, so Palantir is around $14 per share, and it looks like we've gotten up above that 20-day moving average, which is good to see. Getting a little bit of upward momentum at least, and not at least we're not continuing to fall, which is definitely good. So I can definitely see this one working out better. This one is actually for February 25th, which is not this Friday, but next Friday. So a little bit closer in time than the Square credit spread, but this is just a regular put. So if I get assigned on that, it's not as big of a deal, just because, I have the collateral to cover that. And at least at this point, it's still fairly close to strike price, so I can sell covered calls pretty easily if I do get assigned. And definitely something I wouldn't mind. But at the same time, because of my other positions, I would rather not get assigned at this point, just because it would kind of, from my estimation, it would just kind of freeze up some of my liquidity and ability to diversify some, because $1,500 position, that's still a bit of a larger position, I would say. So I don't want to, take it too far, I guess, and have that be too much of my account. And then obviously the last main position here I have is with DraftKings. I had a put at the $41 level and got assigned. So, we're pretty far in the red there. We have a covered call, but, the covered calls are so far out of the money that they're just not doing much. So really just, hoping for a bit more of a recovery, and hoping that our, honestly, if we could just recover to around the 30 level, then my covered calls would be useful and actually producing something. And then, if we could just sit around the 30 level for forever, that'd be fine. I could just get back my money on covered calls. It wouldn't be a big deal. But at this point, it's just so far away from my break even that I just haven't been selling covered calls. And I've definitely considered selling calls below my break even just so I can get some more premium. And in the chance that it, shoots up 20%, 40% in a matter of a few weeks and my shares get called away, at that point I'll just take the loss and, would rather have some assurance that I'm doing something to, you know, make some of my money back and be productive in that method of making some money back and have a chance that, I lose, a few $100s and realize that loss of a few $100s. But at this point, I'm just so far away from the break even that it's hard to really do much to recover aside from just waiting for the stock to do its thing, which could take, who knows how long. So that's kind of what I'm considering. So I might do that. And then I guess the other company I'm doing stuff on in my options account is MJ, which is a cannabis ETF. So I bought a $9 Leaps call out to January 2023 for around $350, I think. And I think I probably bought it sometime mid-January, so I probably had it about a month. And right now I'm a little bit down on the Leap, but I've sold 2 covered calls so far, and basically treating it like a poor man's covered call. And it's not. I don't think the position is completely profitable yet, but it's getting pretty close to that. And even if it takes a few months, I think I'll be able to make some good money off this one, and hopefully, help out my account a little bit, even though it's not going to be a huge money maker because I only have a few $100s invested in there. But any money I make will be better than nothing, I think, from this position. So that's kind of what I'm doing in my options account and kind of my thought processes with some of that stuff. Yeah, earnings is just something like that's a little bit rough for me. I did not realize that Palantir's earnings were tomorrow, but uh, hopefully that will help us and not hurt us. Let's see here. Um, so yeah, let's see, where are we at? Palantir earnings February 17th before market open. So yeah, generally I do try to avoid earnings, but it's something I've done actually a pretty bad job at, if I'm being honest. Just because I think the DraftKings put I was in initially was part of earnings was part of the problem that got me into trouble, and the problem there is once you get in these positions for a few months, then the earnings just continue to affect you. So honestly, just gonna have to weather the earnings, I think, and I guess it's too late to get out of the Palantir put before the earnings. We'll just hope that those earnings are good, and or they don't, for some reason, whatever happens, just hope that the earnings don't sort of damage the stock price, and hopefully it could actually help. But I guess at the same time, I might get involved in some IV crush there and could possibly, the earnings could help me out a little bit in the terms of the actual premium for those for that contract. So we'll have to see what happens with Palantir. I guess I'll definitely be watching it pretty closely. But overall, I think that position shouldn't be that big of a deal, and I don't think I'll. I mean, yeah. Overall, I don't think that position will be that big of a deal, and I think I'll be able to close it out without too much of a loss. But we'll have to see what happens. And with the Square, I guess we could see some IV crush after that, but it's really not. I'm not sure how it would work with puts, but I would guess, or with credit spreads, I mean, but I would guess it doesn't help your credit spreads all that much because, both legs are losing, they might lose some from their contract price, but overall, the gap between them is what really matters in terms of credit spreads. So at that point, you might not get the same sort of IV crush from credit spreads that you would from a regular put. But overall, I think, Square, I'm going to lose money on it, I would say, but just trying for now to wait a little bit longer and hopefully not lose quite as much. So I guess that's where that's at with Palantir and Square and some of my options plays. Definitely learning a lot there and not making the best decisions, not making the best trades, but I'm trying to learn and get better, and that's all I can, expect of myself. And other stocks, let me think if there's any other stocks I've been watching a little bit. I guess one I have been looking at from more of a dividend stock perspective has been Air Products and Chemicals. And we can look at their dividend increase as well, which they announced fairly recently. So let's go on Seeking Alpha first and look at that. If they have it posted, I'm not sure if they do. They have that posted in the dividend history yet. Yeah, so they don't have that dividend increase. Well, I guess they do, yeah. So this dividend is for, it's the first quarter dividend, but it's not. Oh, this is kind of weird, actually. Well, maybe not. Well, the first quarter dividend, but it's paid in the second quarter. So it was about a 8% increase, I think. So 12 cent. Yeah, that's 8%. So it goes from $1.50 per share to $1.62 per share. So that's an 8% increase, which is a little bit lower than their 5-year average, I think, which I think their 5-year average is around 10. Oh, their 5-year average is 12.63%. So that'll probably drop a little bit after this 8% increase. But overall, 8% is still better than nothing. And I guess you could say it's not that good at all this year considering inflation. But again, it's still going to be better than most stocks. And I guess the reason I'm excited, let me get a drink first, actually. The reason I'm excited at this point for Air Products and Chemical stock is because of this chart. And they just had some really negative price action recently, which is exciting as someone who wants to buy more. Not that exciting when you already own the shares and you see that you're down on your position that you've owned for like a year and a half. But aside from that, it's exciting because I can buy more shares at a great price. We haven't seen this price since, really 2020. If we go back a little bit further, we can really see what that's looking like. So the stock was about 255 before the March 2020 crash, and then it got all the way down to around 170 during that crash. And then I think when I first started buying shares, it was right in here, June or July of 2020, and it was in this 230 or 240 level, and I bought like a fair bit right here. And then it jumped up a ton to like 290, and I was like so excited. Oh man, I bought shares at a great time, and it jumped up a ton. And then it just kind of, didn't really do much over the next year and a half, to be honest. I probably bought more in this 250 level again. I bought some more, probably somewhere in here. And then just recently, over the past few days, I've bought some more, which is pretty exciting. This is a company that I like a lot. They're in my opinion, I guess, they are very solid and stable company. It's nothing crazy growth oriented, I guess. It's in the materials sector. So nothing exciting, but the stock price has been doing pretty awesome, over the past 10 years. And the past year it's slowed down a little bit, but that's fine. So overall, I'm pretty happy with the price where it's at. I'm excited for this price. And, if it keeps dropping more, I'll probably keep buying more because it's a very high quality company in my opinion. And like I was talking about with the dividends, they have a solid payout ratio, have plenty of room to increase that dividend. Obviously, it's not super low, but they still have room. And they have been increasing that dividend for a while, about 39 years, and they have a pretty solid 5-year dividend growth rate of around 12.63%. So that's something that I do enjoy from a dividend perspective. So overall, air products and chemicals is one I'm very interested in as well, especially at this point in time with their, elevated dividend increase and their stock price going down. And I'm actually going to look in a minute and show you guys the dividend yield over time, because that's something that I think will be interesting just from the perspective of where it's at, since they actually just increased the dividend, plus the stock price has been going down. So I'm gonna just check my account just to see how big Air Products and Chemicals is. So right now in my dividend account, Air Products and Chemicals is about 7% of the account, and then in my brother's account, it's about 4% of the account. So definitely looking to buy more for the both of us if it continues to drop, and that's something I will definitely do. Like I said, if it does continue to drop. But if we look here at the dividend yield, I think you can see that right now. We'll scroll down to this graph that we looked at before, and we can see the dividend yield is almost at 2.5%, which is, pretty much even in the March 2020 crash, the dividend yield only got up to 2.63%, which is pretty crazy considering, stock price is much higher. Like we saw during the crash, the stock price was way down at 170 and now it's at 245. So it's much higher than during the crash, but the dividend amount has just grown probably by 15% since then. 15, maybe close to 20%. So the dividend yield is a lot higher. And we haven't had this high of a dividend yield since maybe February of 2019, aside from the March 2020 crash. So February of 2019, if we go back and look at the stock price in February of 2019, let's see here. February of 2019, the stock price was around 170. Around 170, generally speaking, between 160 and 180. So again, the stock price now is much lower than it was, or sorry, much higher than it was back then, and they still have a pretty solid dividend yield, and it's definitely a lot higher than it was just a few months ago. Just a few months ago, it was below 2%, and it's been below 2% for the large portion of 2021 and second half of 2020. So again, another positive sign for Air Products and Chemicals, I would say. So I think that's really all I wanted to talk about. If anyone has any other questions or things they want to talk about in the chat, I can certainly look at that now or try to talk to you guys about it. But if no one has anything else, I'll probably end the stream in a few minutes. Just wanted to talk about, the stocks I'm looking at, talk about some taxes things, which I sort of never talked about my personal tax situation. I was answering Jack's question before, but I've been working on my taxes recently. It's been super annoying because I originally started with H&R Block because I thought TurboTax wasn't going to have the free program anymore, and so I started there, and then they basically said that I was going to have to pay since I had capital gains in one of my accounts. And so in order to process those capital gains, they basically said I had to pay like $60. And then I went to TurboTax because I thought I did that before for free, and I was looking like it was going to be fine. And then they said I had to pay again just to do the capital gains. And so at that point I was like, all right, whatever, I'll just pay for it. And then I was talking to my mom, and she was like, well, you can just go on the IRS website and fill out the forms yourself, and it'll take you a few hours, but you should be able to do it on your own. So I've been going through that, been working on that for a few hours, and it's been a little bit difficult to figure out all the different forms you need to fill out. And right now I feel like I'm pretty close to being done. I have all the income pretty much filled out, I think, and most of the, I don't think I really qualify for any deductions or anything. I just take the standard deduction and that's good enough. So I think at this point I'm fairly close to being done, but I have to, go through everything else and figure it out, and then kind of review all the information. The annoying part, I guess, is just filling out all the side forms that you have to fill out alongside your main 1040. So Ruby Red Bacon, good to see you. I do like some bacon, and actually I'm out of bacon right now, which is a very sad thing. Normally I eat eggs and bacon in the morning before my rowing practice, and right now I'm out of bacon, so just eating eggs. But good to see you in the chat. But I think I'm going to end the stream there. Just want to thank you guys for coming on. Rich, he asked if I talked about Palantir. So I did talk about Palantir a little bit. I can reiterate. I do have a $15 put on Palantir, and we can look at the chart here real quickly. But overall, I'm not incredibly worried about that put. I think it'll be all right. My only hesitation is with earnings. Obviously, I can't do anything about earnings because they're tomorrow before market opens. But with Palantir, my put is at the $15 level, expiring Friday, February 25th, so about a week and a half. And I'm hoping that I can get some theta decay to help me out. And I'm also hoping that we get some sort of IV crush from the earnings. I think it's good that the last few days we've closed above I guess it looks like just the last 2 days we've closed above the 20-day moving average. So I guess that's good to see, and it sort of acted a little bit as support here yesterday on the 15th, and you could argue it acted as support today, but the stock price didn't really get down that far. And another interesting thing is that today was sort of I think it's called like a doji candle, where it's stock price opened and closed at about the same level, but it had some spikes above and below that, which is sort of like an undecided indicator. So that's interesting, and definitely not the best sign. It's not a bad sign, but it's not necessarily a good sign. So overall, I think it could go up tomorrow with earnings, and that would definitely help my put. And I guess that's what I'm hoping for. Overall, I think this price is pretty undervalued for Palantir. So I wouldn't mind owning the shares too much, but at the same time, I don't really want those shares to be that large a part of my account. So it's not something I want a whole lot. But if I am assigned those shares, I'm not going to worry about it too much, because the stock price is still pretty close to my put level of $15. So it's really not a big deal, and I would be able to sell covered calls pretty easily, and get some pretty decent premiums on there, and I could probably sell pretty much at the money covered calls and get rid of my shares fairly quickly and make some money on it as well. So Palantir, I've definitely made some good money on Palantir over the past year, but I think I'll probably try to stay away from it a little bit more, just because of its trendy and hyped nature, I guess, and the fact that it's definitely not as proven as some other companies. So definitely with my options, I'm trying to get a little bit more stable, but that's about it for tonight. Just want to thank you guys for coming on, and look forward to a video on Store Capital coming this Saturday, and hopefully I will see you there. And I just want to thank you again for stopping by, and make sure to like the stream if you haven't already. And like I said, I'll see you in the next video. Bye.